policy background. Now, this is a sea change in relation to the international tax arena. There's 145 members of the OECD BEPS inclusive framework, and the substantive majority of territories have already or have indicated that they will proceed with Pillar 2 adoption. The OECD itself estimates that Pillar 2 will result in average effective tax rates increasing across all jurisdictions by approximately 0.6%. If you could move us to the next slide, please. Thank you. So what is Pillar 2 all about? Well, a number of you will know, but it's seeking to set a minimum effective global corporate tax rate at 15% to stop the so-called race to the bottom of corporate tax rates and to reduce the incentive for base erosion and profit shifting between jurisdictions based on the tax rates between those jurisdictions. So before we get into the detail, let's first bust a few myths. So the first one, I'm only in high tax countries and therefore the rules are not relevant to me. Well, the OECD estimates that high tax jurisdictions, being jurisdictions with average effective tax rates of above 15%, account for 53.2% of global profits taxed below 15%, which is actually much more than very low tax jurisdictions, so jurisdictions with effective tax rates below 5%, which only account for 18.7% of low tax profits. So you might find some surprising outcomes. Secondly, I won't have any top-up tax and therefore I don't need to do anything. Unfortunately, you will still need to prepare calculations to demonstrate there is no top-up tax, although safe harbors may help to simplify that process in initial periods. And we'll talk about those safe harbors in a bit more detail next. Myth 3, the tax return is not due until 2026, and therefore I've got a long time to work out what I need to do. Well, there will be a requirement to disclose the expected impact of Pillar 2 in your accounts for any periods ending on or after 31 December 2023, and work will need to be undertaken in order to be able to make appropriate disclosure in those accounts. 4, it's a group level issue and head office will look after it. So although the primary taxing mechanism is at a group level through the income inclusion rule, which we'll explain in a bit more detail later, most territories proceeding with Pillar 2 are implementing a domestic minimum top-up tax, and so the calculation responsibility can sit at a domestic level. There's also very likely a local statutory financial statements disclosure obligation in light of that, and as a minimum, even if there is no local compliance or a disclosure obligation, there will be a requirement to provide data to group, and systems and processes will need to be established to enable that. Next slide, please. So a bit more detail on the rules. They are drafted to apply to multinational groups with annual consolidated group revenue of at least 750 million euros in at least 2 of the preceding 4 years. The rules have been drafted at the OECD level, and you'll hear reference to the OECD model rules when people talk about Pillar 2. That is a framework which countries implementing Pillar 2 are suggested to follow, but there are certain deviations that a local country is permitted to take from those rules. So understanding the local implementation of the OECD model rules in the jurisdictions that affect you will be important. There are some excluded entities, but notably these are excluded entities, not excluded sectors and not excluded groups. So even if you have an excluded entity in your structure, there could still be investments of those entities within scope of Pillar 2, depending on your specific facts. Now, as a final comment, there is a country de minimis, but it's set at a relatively low level, and it is an and test of both revenue and profit. It may help simplify compliance processes in some instances, but it's unlikely you'll be able to rely on that in its entirety. Next slide, please. So in terms of the framework of the rules, there's a few different components to them, and I'll just touch on a couple of them at a high level. So the primary component of the Pillar 2 package is an income inclusion rule, which should be viewed effectively like a super controlled foreign company rule, providing taxing rights over low tax profits of subsidiary entities in the territory of the ultimate parent of the group. As a backstop, you've got an under-taxed profits rule, which operates in the same way in terms of the determination of low tax profits as the IIR, but it provides the taxing rights to a parent or brother and sister jurisdiction, depending on the specific facts of your group structure and how that interplays with which territories have implemented or will implement Pillar 2. Then there's a domestic minimum top-up tax, which territories are permitted to include, which works again on the same calculation principles in broad terms, but to the extent that there is a top-up tax due on low tax profits, that taxing right sits at the local jurisdiction level. So really that's just a question of where the taxing right sits as between the IIR, the UTPR, and the domestic minimum top-up tax. There's safe harbors that apply in relation to those, which we'll go through in a little bit more detail. And there's also a subject to tax rule, which we're not going to cover today, but this provides additional source territory taxation rights in respect of certain low tax profits on certain intragroup transactions that can override current treaty mechanisms. Next slide, please. So in terms of the computational approach, we would suggest generally a 6-step approach. First, some work to identify the ultimate parent entity and the constituent entities on a jurisdiction by jurisdiction basis. For many groups, that'll be obvious. It'll be the group at which the consolidated accounts are prepared and all of the entities included within those consolidated accounts, but there can be some nuance to that for more complicated structures. We then suggest consideration of the safe harbors, to try and simplify the compliance processes to then enable a more focused approach, at least in initial periods, to determination of the likely impact of the rules on your business. And we'll go through in a little bit more detail what that calculation looks like.